Imagine you're hiring someone for one of the most important jobs in your portfolio, replacing your paycheck. Would you hire the first person who walked through the door? Or would you compare experience, reliability, strengths, weaknesses, and whether they actually fit the role? That's exactly how I think about high-income ETF. Yet, every day I see investors buying the highest yield without asking whether it's actually the best fit. Today I'm going to show you the framework I use instead, so stay tuned. Welcome back to Simply Money. In our last two videos, we talked about building a team and defining the jobs that need to be filled. Today, we're hiring. Let's say I've decided I need another retirement paycheck ETF. The question isn't, which ETF has the highest yield? The question is, which ETF deserves the job? We're going to start by looking at 5 ETFs and their trailing 12-month yield. And we're going to see why this can be misleading. First, we have CHPY with a 36.97% yield. Right behind that, we have EGGY with a 34% yield. Leading the way, we have AMDW with a 50.09% trailing 12-month yield. Then we have SPYI, which has a 12.06% yield, and IWMI, which has a 13.76% trailing 12-month yield. If yield was the only thing that mattered, the decision would already be made. We'd get AMDW. And then maybe CHPY and EGGY would be the next two that we'd look at. So say we needed 3 ETFs for our income portion, and we picked the highest 3 yields, we'd pick AMDW, CHPY, and EGGY. But we both know it isn't that simple. And this is why I developed the Simply Money score with income versus decay ratio. Before I hire anyone, I want to know more than one number. I want to look at historical total return, income generated, NAV behavior, DRIP performance, income versus decay, and the DRIP opportunity score. Whether I'm dripping or not, I want to see, is it better to drip, and is now a good time to be dripping in this fund? So I want to show you the Simply Money drip score here and why I use it. Because if you were just looking at those 5 funds and you picked yield, you would have picked wrong in my opinion. Yes, AMDW had a 50% yield, and its total return for the last year has been phenomenal, 187%. Likewise, CHPY, you probably would have done really well with an almost 37% yield and about an 82% total return for the last year. However, if you put EGGY in there, even though it had a 34% yield, it had a 3% total return because of the price depreciation. And that's where this tool comes in handy, helping you make those decisions looking beyond just the yield. I'll give you an example here. We'll look at AMDW since it did so well. This is based on about a year's time frame, so it could be a little bit off from what I just shared. Different time frames it'll show differently, and that's the good thing about this. You can go from inception. You can go for the last 5 years if it's been around that long. You could go for the last year. Maybe you just want to look at the last 2 months or 3 months and see how's it performing lately compared to other funds. So it gives you the opportunity to do that, and each one of these tickers has its individual sheet. You can go here to AMDW and you can see I can change the starting date and it'll update the share price, and you can put in the amount that you wanted to look at. I have $50,000 in there just to run the numbers. The percentages are going to be the same. But on this, as you look, you can see that the price appreciation has been 80%. So not only has it been paying an incredible distribution, the yield of 50%, you can see your total return here in that time frame showing at 253%, and it is down right now compared to what I have here because of the market over the last few days from when this is being recorded. But again, I could go in and change the date, I can update it, and get the most recent information as I'm running these analysis. It shows you whether you dripped or don't drip or 50% drip, how the return would be. So you can see that dripping, the drip score, you did 93% better by dripping versus not dripping. So green lets you know that dripping is better, and by how much. If you can look at like BETH here, you see that it is red, meaning that not dripping, you did better than dripping. However, on this particular one, you did bad on any of them. You just did less negative return by not dripping. So it gives you that feedback right here and a quick look at chart you can see the income versus decay ratio. And what this is doing, it's comparing how much income is being generated versus whatever decay there is. This is purple. $9.99 purple means there's no decay, means the price has actually appreciated. So it's really not a factor in that sense. Now we could look at ATCLE here. You can see that it did have green, meaning there was some depreciation, but it was more income than the NAV decayed. So that is important. Is your income outpacing the decay? If it's not, that could be something you need to look at, especially long term. Short periods, it's not quite as significant. But long term, that could be a warning sign that it just can't keep up with the yield. And so it's just giving your money back and you're losing value. So it's something to look at. And this, again, is a tool that helps you do that. And then you can see over here the drip opportunity, meaning right now, based on the time frame I'm looking at, would it be beneficial to drip? Doesn't mean you have to. It just means, would it be beneficial to drip? And this on AMDW says absolutely, it's in the elite rank with a 92.5 score, because you can see how well you did with dripping with a 253% total return by dripping. And that's significant because some you don't want to drip. You can see others that the score's not as high. We could look here at CHPY, same thing. It has a strong opportunity for drip, and that was elite just about a month ago, but CHPY has been really down in July with semiconductors pulling back. I'm not worried about it. I get a lot of comments, people saying, oh, CHPY's done with, it's over. I don't believe so. That's my opinion. You can do with that what you will. But this chart gives me an opportunity to monitor things, see things, and this is my interviewing questions. This is what I look at. When I'm looking for an income team member to put onto that department, this is what I go to. I pull up my drip sheet and I start doing some comparison. I narrow it down and I'm asking those questions. What is the historical total return? What's the historical total return if I drip or don't drip or do partial drip? Because when I retire, I probably will be doing partial drip with some of my income players, because I want them to continue to build and develop down the road and increase my income. But that is just one of the things. I look at the income generated. Is the income consistent? Is the income fluctuating too much for me? Is the income pulled back really hard when the price fluctuates? What's the NAV behavior? If the market and the underlying fund is going up, is the NAV still going down or staying sideways? Or is it able to go up with the market? Does it lose some of the upside? Probably. But does it capture some of the upside, where some funds, even when the underlying fund is going up, they're still flat or going down? Again, I look at the drip performance and I look at the income versus decay that I just showed you. And then because I am dripping currently, I want to look at the drip opportunity score. Perhaps I still hire an ETF that it's not getting a good drip opportunity score, but it checks all the other boxes, and I can use that for cash flow into something I do want to drip in currently. These are the metrics that I'm looking at when I'm hiring. This is the Simply Money Drip Score with Income versus Decay Ratio tool that I have available on Buy Me a Coffee in the link below. If you'd be interested in getting a copy, I appreciate all the support for those who have bought one of those. So let's do some comparison. If we look at CHPY versus EGGY, we see two funds that have almost identical yield. They were at 37% and 34% for EGGY, but CHPY outperformed it by about 79% on total return. So that's something you want to look at. Or how about CHPY versus AMDW? Now here, this could be a little bit different for people. I'm looking at it saying, well, yes, AMDW did better, but I also have something I look at. What are the underlying funds? It is one company versus CHPY having 30 companies. So for me, somebody who likes diversification and likes my portfolio to have some of those safeguards, I might lean toward CHPY. I actually have a little bit of both. Again, they can both fund a different amount. Instead of putting all of my resources into one, perhaps I hire two part-time people. Just like in a company, maybe I want this person to focus on this and this person to focus on that. I can have two ETFs, and split the duties where one has a strength here and another has a strength over here. Or perhaps we could look at SPYI and IWMI. Again, very similar in their yield, but IWMI actually had a 30% total return because it's a small cap fund. In SPYI, it had a 15.76% total return. Both very good. I'd be happy with either. But again, for me, and I do have both of those because I want some S&P 500 exposure with my income. I also want some small cap exposure with my income. So they both in the income department play a role. And so I split some of my allocation between both of those. So there are strengths, there's weaknesses, and there's trade-offs with it, whatever fund you're looking at. But remember, the question isn't which fund's the best or which fund has the highest yield. There are a lot of metrics you want to look at. And first thing you need to decide is, what is the job I'm trying to fill on my team? And we're looking here today at the income job. We need something to provide us income for retirement or early retirement or supplemental income, whatever the case might be. I'm not looking for the winner. I'm looking for the best fit for the specific job, and that is the philosophy that I use. So when it boils down at the end of the day, when I'm ready to make a hiring decision, it's based on the data, and I ask if my goal is X, then this ETF earns the position if it fulfills that. Not, this ETF is the best. There's a big difference. What is the job and which ETF fulfills that job the best? Again, you might have multiple members on the same team, just like in a company. We have different players on a team. We have the offensive line. You have different positions. They each bring different strengths and weaknesses, but they're there each fulfilling a particular job. So you want to figure out what their job is and what position they would best fit in. And if they meet that, then hire them. So the biggest lesson to me through this is the framework doesn't make the decision for me. It helps me make a better decision. That's what data should do. It should support good judgment, not replace it. Remember, this is not financial advice. This is for informational and educational purposes only. Please do your own due diligence. That is the whole reason I started this channel, and I provide these tools is so you can look and do your own research and run your own numbers and have enough available to help you make that good judgment. But you have to decide what is best for your team. This is my portfolio. I'm making decisions based on my goals, what my team looks like, what my needs are, what my allocations are, what resources I have, all sorts of different things, because personal finances are personal. Now, we've hired the right players, but every great team still has one challenge. How many players should each position have? How much should, say, SCHD represent? How much income is too much? How much growth is enough? That's where we'll go next. Choosing an ETF isn't about finding the highest yield. It's about finding the right investment for the right job, backed by evidence, not emotion. Remember, every ETF has a job. Every job has a purpose. Most people answer, what's the best high-income ETF? I prefer to say, show me the job description first. Then we use data to validate the hiring decision. That's a subtle shift in why the drip score is a vital tool for my process and my decision-making. I appreciate you joining me, and we'll see you next time on Simply Money.